Now we're going to invite the next speakers on stage to speak about banking and tokenization. This panel will be moderated by Alex Buelau from Rails. And please welcome Rajeev Tummala from HSBC, Danielle from Standard Chartered, and Matt from RedStone.
Welcome to the panel discussion exploring the evolving landscape of RWAs, real-world assets. I'm Alex Buelau. I'm a co-founder at Rails. Rails is a blockchain and layer one, EVM layer one, that is built for banks and financial institutions. And so this topic is really close to my heart because this is one of the things we do in Rails, tokenizing receivables and yield-bearing assets. And as a bit of, let's say, context setting, RWAs are growing, tokenization is growing. There's different estimates, but the one I have access here is that tokenized assets have surpassed $10 billion with banks like HSBC and Standard Chartered leading this revolution. But still, the market is very fragmented. I think everyone can see this. There's no proper standard. Things are a bit slow. There are some estimates that say only 2% of the total TradFi assets have been tokenized so far. But there's a lot of potential. Some think that by 2030, more than $1 trillion of assets could be tokenized. And so I think the discussion here today is for us to understand from the perspective of the financial institutions how they see this process going. And so without further ado, can I please ask you guys to introduce yourself, maybe starting with Matt.
Hey everyone, Matt Gurbiel here from RedStone. RedStone is the fastest growing Oracle provider, which means we provide pricing data for DeFi to enable the DeFi markets to exist, and we especially specialize in yield-bearing collateral for lending markets.
Hello everyone, Rajeev from HSBC's Securities Services division. We sort of run all our digital assets initiatives from this particular division. Have always been focused on what I would call as bringing off-chain assets to on-chain environments, right? So that's primarily, tokenization is the bridge that sort of, where off-chain assets travel over to have their on-chain versions, and we've been doing that for about 6 years. Probably the bank that has issued the largest number of on-chain assets, financial assets, on-chain right now.
Hi, so I'm Danielle from Standard Chartered. I'm from the Digital Assets Centre of Excellence, which is a terrible name. Don't call me out on it, but we didn't choose it. But our team actually sits across all of the bank in terms of owning the collective digital asset strategy for the group. So whether that's across our ventures, our wealth and retail arm, or our corporate institutional bank, we basically own the strategy for digital assets across that. And actually, we're reasonably differentiated from our peers because we've actually taken quite a focus on public chain, permissionless infrastructure. And of course, we have done plenty of experimentation in the past in private chain types of initiatives. But certainly, I think our focus on permissionless has always been, from a certain truth that we believe that, permissionless chains actually hold scalability. And so, of course, with everything that we're seeing at the moment in terms of tokenized money market funds going on permissionless chains, stablecoin growth, I think we're certainly very excited about that, and we've been leaning in, I think, for quite some time.
Cool. So I have a question for Rajeev. Just to get started, HSBC is such a reputable institution, lots of huge legacy, especially in the security services. And so I'm curious, from your perspective, and especially thinking about data-driven, answers here. So I know about the Hong Kong's HKD project that showed a reduced transaction time of 50%. So things like this are very important that we put measures in the answers. So how do you think that HSBC's legacy affects and drives the tokenization within the bank?
So when you basically look at assets value, and you gave out some numbers, right? So 1 trillion. If you primarily look at just the financial assets landscape, let's exclude physical assets like real estate, paintings, and other illiquids, right? So just look at financial assets and look at the market cap of listed financial assets across bonds and equities, right? So more liquid ones. They do have restricted operating hours today, including money. You'll easily have $300 to $400 trillion worth of assets out there, and the opportunity is to sort of how do you bring them on chain. Most of banks, whether betting on private or public chain, they will have to converge. That's a given, right? So where irrespective of you start, there will be many networks. That's basically our view. And these networks have to talk to each other. Today, also, there are many networks. Each bank runs their own internal networks. We are present in 68 markets. And we have an internal network that connects all, but we also work with every other bank on the street. Similarly, we are in the very early stages, but public blockchains do have utility, I believe. Whether we'll end up moving all of the value on public blockchains and whether we'll basically use only bearer forms of value, I don't think there is one single answer in that particular space. But legacy, as you pointed out, what it needs is there is forms of value already issued, right? Even if I continue to issue new forms of value completely on chain, in 5 years' time you'll only have 2 to 5% of value issued on chain. Now, institutions like ours do have, I think, responsibility to look into what does that bridge look like. And most of us think that this is the first time it is happening. No, it has happened before. Right? If you primarily go back and look at how listed assets were represented before databases were created, they were all paper-based. And when better technology came along, we introduced the concept of book entry securities, centralized ledgers, and all of that was converted in. We went through one phase, so that there's a bit of muscle memory there in the institutions. And of course, right, tokenization and digital assets are much better way of representing assets. We will end up there. You need to have bridges. Yeah, you will have legacy. We will have to deal with it, unfortunately, and we'll have to figure out a way of efficiently transitioning that with, of course, regulatory clarity and legal recourses. And that's primarily where the opportunity is, right? So we have already created issuance of new forms of value. And we're now thinking about how do those bridges look like for converting existing value on chain.
Thank you. And now, Danielle, similar question to you, but of course, Standard Chartered, the legacy is more in corporate banking. I know about you have these vaults that yield 3 to 12% tokenized assets that are yielding 3 to 12%. So can you give your view on how is it that Standard Chartered sees the tokenization and the future?
Okay, so I think let me take this in terms of like how we look at this from a strategy perspective, and I think that it will be instructive with respect to the journey that we're on and where we kind of see markets going in tokenization. We made bets quite early through our ventures division. So Standard Chartered Ventures, we invested in Ripple as early as 2016. We actually built 2 ventures, Zodia Custody and Zodia Markets, so a institutional custodian and an institutional brokerage for crypto assets. Mm-hmm. And this was grounded on our core thesis, which is, yes, we believe that tokenization of real-world assets is coming, and that is obviously the big prize. But it's going to take some time to get there because there were some fundamental things in the ecosystem that were missing. And so we grounded those on 5 core capabilities: access, execution, custody, tokenization, and interoperability. So you can see there where you've got access through the likes of Zodia Markets, custody, of course, through Zodia Custody, which we actually now do also offer directly through our actual Standard Chartered Bank, where we are the first GSIB that actually operates a fully bank-backed crypto asset custodian as well as digital asset custody. And we've also got our tokenization venture, Libera. I think Alex is around here somewhere. Go say hi. Hi. Which is actually working with a lot of these different fund managers looking to tokenize funds. So I think for us, it was like, okay, if you want to actually have a wider ecosystem, because it's all well and good to originate assets and put them on chain, it doesn't really mean anything until you've got counterparties who are actually able to then take those assets and hold them on chain. So if you're standing there with the only capability, it doesn't really make a lot of sense. So we set about building the custody solutions, the access rails, the execution capabilities, the tokenization, because we felt that that was important to get the rest of the market equally able to actually deliver and hold and trade assets to the same value. So on that basis, and because obviously crypto assets were the area where the money was, we invested there. That clearly yielded results. Zodia Markets nowadays, I think, is one of the top 2, if not actually one of the top minters of USDC stablecoin at the moment. We're seeing tremendous results with respect to client demand for these different solutions, and I think we can come and talk about that later if you want.
So there will be 2 patterns that you will continue to see, right? One is exactly right. So issue value and develop an ecosystem, all right, around it, so that people gradually join. The other pattern would be what we are following is we make the value issued on chain fungible with off chain. And that's probably the reason why we have the highest value issued. And we work with FMIs. That is the differentiation factor. So there will be many patterns that will be emerging and not a single pattern. If you work with an FMI, then you automatically get access to that FMI's network. The FMI is basically involved in creating fungible forms of value. You can issue digitally native. And access is what matters. Now, access can come in many different forms. That is, you develop an ecosystem, you just make your value fungible across by having the right bridge.
Yeah, and Matt, so I guess we've been talking about, custody and tokenization, and, there's also mentions about, how to connect off-chain assets to, on-chain information. And I guess this is a nice segue for RedStone, because I think there's a piece missing here, which is, okay, you can tokenize, let's say, financial assets, and most of it is already digital. But if you tokenize, let's say, real estate, then how can you connect, the offline real estate with the online world?
Well, actually, there's a couple of aspects to unpack here, because the problem that you're tackling here or touching upon is what we call price discovery. And price discovery is a problem both for something so idiosyncratic as a property would be that you would like to tokenize on-chain, but also price discovery is important for the traditional financial assets if you want to use them in DeFi. So basically the way to think about this is that an oracle on a blockchain is needed pretty much every time you want to build financial infrastructure that is just going to be autonomous, that is not going to rely on the decision of a person, is going to rely on some data that needs to be fed into that blockchain. Because a smart contract on-chain does not see beyond the state of a given blockchain. And if the question is, okay, when do I liquidate a position on the lending market, that decision needs to be taken automatically by the code, but it needs to be taken based on the price on the global market. So the oracle's role here is just to tell the smart contract, hey, the price is X, Y, and Z, so please liquidate, or please do not liquidate. And then we go further and further down the long tail spectrum here, and there is more and more idiosyncratic stuff that you can think of in the context of price discovery. So these are all the things that you've mentioned. For example, trying to tokenize properties. How do you actually price them? Trying to tokenize some private assets like OpenAI, for example, right? How do you price them? This is a lot of those questions we don't really have good answers to. But in general, the way we see the role of an oracle is basically the enabler for any activity that's related to DeFi, especially on the lending side of things, or especially on the synthetic side of things. Because if you want to create a perps market, well, that market is entirely based on the outside information. It's not based on the underlying asset. So, the oracle just becomes a critical piece when it comes to those types of financial products on chain.
Okay, and so that's an interesting, because we are talking about all the pieces of the puzzle that need to exist, right? So that we can finally deliver, the dream of tokenization and the vision we have. And so going back to Rajeev, so the partnership with BNP Paribas for custody, how is that going to help HSBC? Especially in things like, for example, AI-driven trade flow shifts and any other aspects you think? that are affected by this?
So I think largely, right, you got to basically also look at, there is a geographic dispersion. We need to invite a few of our peers who actually are aligned to the patterns that we think will help scale. And that's primarily where there is a complementary geographical presence, that is in Europe, continental Europe specifically. You can pull up the new and the old networks, because there is a relationship there in the traditional world as well, and you sort of invite them onto your new platform. And specifically with respect to the custody partnership, the custodians have always worked with each other. So you offer, I mean, there's a concept of global and sub-custody networks, etc., right? So we are one of the world's largest sub-custodians, that is, we service other custodians. So how do you then enhance a custody network that is going, that needs presence in all? Especially when it comes to this form of assets, there will be an ask in terms of, no, not the asset, because the asset is broadly borderless, but keys. So you need to sort of begin to work with, very early days, I should say, but you should be able to sort of begin to, and your clients will have preferences, and your regulators will have preferences, because the clients are regulated, they would have preferences in terms of where the keys, where and how the keys are managed. That would be driving some of those decisions, but yeah, you will have to basically find partners that are aligned. There is geographic complementarity. That's basically how you do. And then, of course, right, so the coming wave of other new emerging technologies, can you partner? Because most assets, you got to look at a life cycle of an asset, even after you sort of tokenize. A lot of it can be managed through smart contracts, but there will always be a last mile variant. So how do you basically co-develop a library of smart contracts that know how to manage assets based on under what laws they have been issued? So we can't wish away that. So that's primarily where I think a small group of similar-minded peers coming together will be of help.
Okay, and Danielle, going back to you. So what kind of KPIs or data-driven KPIs do you guys look at in terms of, like, for example, expansion of market share of tokenized commodities, or maybe ROI from Libera? I mean, what kind of things are you looking at?
Maybe Alex should answer that question. Yo, what are your KPIs, mate? No, actually, I think that we definitely have an eye toward... So again, coming back to the macro, we definitely have an eye toward where the actual market trajectory is. And I think, certainly on Rajeev's point that, it's nice to kind of have a look across the sort of like-minded banking peers and sort of see what's actually happening. So, should we be looking at different ecosystems where you can see, what volume of assets they have on chain, et cetera, et cetera. But actually, that's all well and good. I think we're more interested in things like, where is the overall market going? And I have to say, it is very stunning for us when we actually look at the sudden growth of things like tokenized money market funds on chain. When you look at the developments that are actually happening where people are actually, like the asset managers like DRW Cumberland and all of these guys are actually shifting a lot of their activity and trading into places like Canton, we have to kind of look at those sorts of networks with respect to the volumes they're doing, and therefore what is our choice when we're onboarding some of these networks to participate in. So I would be looking at those sorts of things, to be honest, because this is where we're looking at where our client demand is, where our client activity is, and therefore the signals around where we need to be investing to ensure that we've actually got capabilities to actually tap into those particular networks and ecosystem. Because I don't think we can afford to believe that we will always be in these very small consortia anymore. I just don't necessarily think that's where our clients will want to play. Our clients expect us to be able to support them connecting with digital asset ecosystems wherever they are. And that might actually be regulated FMIs that we love, like Euroclear, but could also be digital FMIs that Euroclear is building, or potentially could be DeFi ecosystems guided by oracles. We don't know. So we're constantly looking for data signals in some of these different areas as we do our experimentation. But at the core of it is where we're building these interoperability layers to say, well, okay, it's very expensive to sit there and just test and test and throw and test. we are actually investing to build infrastructure that allows us to actually deploy experimentation into these particular areas very quickly. And again, unfortunately, that does mean that we kind of have to understand how to actually operate things like blockchain nodes and blockchain indexing and all of these basic building blocks in-house.
Cool. And I guess a similar question to Matt. Because you guys, you have access to all data across different clients, right? So you must be in a good position to kind of understand, first of all, maybe you can explain what institutional DeFi is, like define institutional DeFi, and then, can you tell us what kind of KPIs do you look at? I mean, do you feel like what we're seeing today, the adoption, is it sustainable, or is it more kind of people speculating and, maybe not going in the right direction?
Right. So when it comes to how DeFi on the institutional side of things looks like, well, this is a very, very new thing just because the biggest market globally, the US, just opened basically end of last year and this year. We went through a couple of little cycles of institutions, people trying to put stuff on chain. The first wave was definitely treasury bills, probably the easiest product to conceptualize in the blockchain context. There is a lot of money market funds that are focused on this already on chain. The second wave that we saw was and still is private credit. And this makes a lot of sense in DeFi, private credit especially, because DeFi as it stands today needs high yields to be able to have what we call a leveraged loop exposure. So institutions and individuals use lending markets to borrow stables against collateral in the form of, for example, Apollo's Acrid, which is yielding 8 to 9 to 11%. And this yield has to be higher than the borrowing rate in DeFi, which is floating. That depends on the market conditions as well. But on average, you should be in the green zone while leverage looping something like private credit. So that's why this kind of an asset is interesting to today's users of the protocols like Morpho, like Euler, like Aave, like Camino, and others all across the ecosystem. This is where we stand today on the public blockchains. But as we speak with more of an institutional type of clients, there is many different use cases that people see also when it comes to potentially using the public network, but having a private instance of a given market. So, for example, a private instance of Morpho so that you as the borrower or the lender are not exposed to the interest rate spikes that can happen on the global market. There is many institutions interested in fixed rate lending as well. An interesting product here might be Morpho V2 that's coming soon, focused especially on fixed rates, which has not been too popular before in DeFi, but obviously this is the obvious use case that everybody sees as potentially the next step for what DeFi looks like. When it comes to the metrics, we've seen the headlines made by, for example, BlackRock's Buelau, probably the biggest tokenized fund to date. We also work with Securities, so the tokenization platform for BlackRock Buelau, so we provide the price feeds for Buelau on-chain. This has been growing quite nicely. We've reached a certain point of, I would say, plateau for the time being. But that does not mean, that market does not have a future. I guess it just means it's not going to be a continuous growth. It's going to be more of a step-by-step rollout. And this is also what we've realized. Making institutions and the managers managing the funds, the money, comfortable with that new technology, it happens in steps. It doesn't just happen as a single, as a single event. So probably we will see a little bit of a contraction on that market, but possibly in the future, especially when it comes to the money markets focused on T-bills. But that's fine. Every time there is a new unlock in the Web3 industry, we kind of see the Cambrian explosion of new companies, protocols, institutions trying to do the same thing. And then some of them stay, some of them fold. And then we move to the next step, but we are wiser with the experiments that we've done, right? So we now know that T-bills work well on chain. We now know that it makes a lot of sense to actually hold the yield-bearing money in your wallet as opposed to the non-yield-bearing money, and that this is actually available to individuals as well. as opposed to being only available for the selected few. And we are kind of moving past that stage. We also do know that private credit works well with DeFi because it's a high-yielding asset. We know you could use that. We know Apollo Acrid did well with the integrations that we've done with them on Morpho and Camino. So the question is, what's next? Is it going to be new asset classes? Is it going to be new sources of yield in DeFi? Or perhaps maybe it should now go the other way. And there's a lot of fintechs, a lot of financial products being built that way, where it's all about enabling the retail user or the institution to actually access the DeFi native yield, as opposed to trying to bring the yield from the outside to DeFi. So this is kind of this little inflection point that we are in right now. Nobody really knows which way this is going to go first, probably both of them in the longer term. We, as an Oracle provider, kind of have to go where the market tells us to go. If private credit is the name of the game, we have to be doing private credit price feeds, and then just taking it from there, depending what the clients request from us.
All right, and so just following up on that, Rajeev, how do you in HSBC see RedStone's technology? How can RedStone technology and Oracle's technology help to ensure that there's data reliability for tokenized assets?
Yeah, again, it comes to the scale, and I agree to the points being made, right? That I think for scale you need simpler products that people can understand, not more complicated products that people are not used to. And the growth will be across two margins, right? So even if you take the money market funds, right? So the two more famous funds, between them, Benji and Buelau, probably have about 3.7 billion. Like a single money market fund in off-chain probably has, of institutional grade, has over $100 billion, right? So simple. So there is so much of headroom to grow. Stablecoins would probably bring in a bit more liquidity. They would definitely act as catalysts. But availability, I do think that like data services on blockchain, there is availability of them. Now, they have to be stress tested. And for stress testing, you need to scale. For scale, you need to have simpler products. But we seem to be having more complex products than simpler products. So, in fact, the success of Benji and Buelau is owing to their simplicity, that people understand, they can map out. I do think that stablecoins will then now sort of demand simpler products because more people will continue to have. Still, we are in a world where there is intraday yield. Maybe we'll need to go to a intra-hour yield and minutes and yields by the minute, right? You don't need, because there are, again, one of the things is that there are no underlying instruments that yield, so you can't basically map it out. But you can always give out entitlements, right? So that is basically the power of smart assets. That is, you can give an entitlement depending on the time period in which you owe. We have not yet seen simpler products that will actually bring more demand. Demand for access as well will come through. That would then, so we will be all in a virtuous cycle of simpler products, more access, need for data services, and we'll continue to build a portfolio of options, right? So there will be many different ways of scaling. You can scale on the DeFi world. I don't think a normal retail user would definitely jump on. But there's going to be a segment, the younger cohorts will jump onto that kind of attractive yield. But there are two things that come on board, right? Client suitability is always going to basically be backbone of what institutions offer their clients. The second thing is smaller values don't mean, automatically client qualifies. Fractionalization is good, but it provides access to the right clients, not all clients.
All right, that makes sense. And so I think we're running out of time. I just wanted to ask, maybe starting with Danielle, any final thoughts on tokenization and are you excited for the future?
Yeah, I'm massively excited. And actually, I'll pick up a tiny bit on that last one, because actually I do think, I wish that our banks could use a data oracle like yours, because it basically means that we would have so many non-discoverable or previously non-kind of price discoverable assets on chain that we could actually be helping to facilitate execution and distribution for. I think we're a little bit away from that because obviously the kinds of assets that we're predominantly playing in now are things that we know and understand and that our credit officers understand, so trade, etc. And of course, that's all internal models, and it's hard enough as it is to get them to even understand and figure out our haircut for Bitcoin. But, we'll get there, I think. And I think eventually what really will be driving the need for us to potentially get into that space, to my mind, is in that intersection of some of the things that the Huma guy was talking about before, particularly where you've got agentic AI that's actually driving more digital asset-enabled rails. And as different types of institutions and clients and retail users actually start engaging through those types of interfaces and those types of agents, as a bank, I think we have to figure out how we actually interact in those ecosystems, because that is the disruption. Those agents are actually going to be the intermediaries, not the banks anymore. So unless we can figure out a way to actually get into those ecosystems, and in doing so, of course, that means being able to actually figure out ways to work with smart contracts, work with price discovery vehicles, and like RedStone, we may not necessarily have a market left. So I think it's a terribly exciting time to be a bank. It's a terrifying time to be a bank, especially a credit officer. But no, I think that the opportunities are there for those who can actually figure that out.
Okay. Rajeev, same question to you.
Yeah, I think a combination of AI and distributed ledgers and digital assets is a wonderful combination, right? Traditional finance has always had a lot of variance. Actually, now what you have is AI at the bottom. The TradeFi interfaces, there's significant variance there. Each one has their own ways of offering interfaces. So I think at the bottom layer, it's like a sandwich. The bottom layer is about standardizing, or not even standardizing, right? Addressing variances through agentic AI, right? So they deal with it. The top layer, I think, is about offering intelligence through agents, because the bottom layer standardizes, normalizes, and puts everything on a chain. And then the top layer basically acts on the intelligence that the normalized layer basically offers. But a combination of these two things will, I believe, drive accelerated adoption. That's what I think, yeah.
Matt, same question to you.
So to me, the very important shift now is that the narrative, it doesn't have to come from us, the crypto people. It actually comes from you guys now, okay? The thought leaders at big reputable institutions, banks, asset managers, and others. And, so we've done something right for sure as an industry. And this is kind of the force multiplier right now. So this really makes me excited about this, so that it's a stream that goes. Whether, we are here or not, it just goes. You can't really stop it. So, it's just going to happen. And it's great to be in that stream as well.
Yeah, second that. All right, so thanks to the panelists. It was a very insightful conversation. And can I get a round of applause? Thank you.